This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a fresh new week, Monday morning, bright and early. Not bright, really. It's a little dark and cloudy outside.
At least it's not pouring, Prashant.
It's not pouring, but the weather is beautiful. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia, and we have Surabhi with us today over the next 2.5 hours. Guys, hi, morning.
Hi, morning.
guys.
And I think after 10 days, we finally got to see the sun in Mumbai this weekend, right? Yesterday,
Yeah.
it was a bright and sunny day. So hopefully, it'll be a bright and sunny day on Dalal Street as well. But so much to track this week. I mean, we say that every Monday, but, we're in the thick of the earnings season, so lots to track, perhaps.
Yeah, and we're not lying. There is a lot to track.
There is a lot to track. Or maybe just we have a lot on our plate.
I mean, it's
Earnings
packed.
season,
It's
so
packed.
it's a little breathless, but I think, we in the
It's
market's
par for
pretty
the
used to
course.
it, yeah.
All right, well, let's start the the run here over the next 2.5 hours because there is so much to track. Okay, this is what you need to know as we begin another trading session. And it's positive. I'll tell you why. On Friday, to begin with, where we left off, Nifty and the Nifty Bank took support at the 20-day moving average. The 20-day moving average is an important line in the sand between turning bullish and flipping towards the bearish side. We hit the 20-day moving average. In one case, breached the 20-day moving average, but closed above it. So that's point number one. Now, keep that in mind. I'll come back to the levels a little bit. What is the handoff from Wall Street? And this is important. Remember, this is important because on Thursday, we had U.S. markets which sold off aggressively from 52-week highs. You had 2.5% reversals on Thursday. So there was no follow-through on Friday, and that's why it's important. NASDAQ was up 1.9%. The S&P was up about 1% as well. The data backdrop, I think, is what is giving more confidence to bulls this morning. So data points to a Goldilocks scenario, not too hot, not too soft. And if you want to talk about the U.S. economy, a perfect soft landing. I mean, there is nothing called a perfect soft landing, but so far, I mean, data indicates that it is going to be what the Fed really wants. A soft landing, which is not too disruptive. And this is the reason why. This is the latest three data points. We have on the inflation front, we have the core PCE and the employment cost index, the ECI number. Both are tracked by the Fed closely. Both of them indicated that that inflation is continuing to soften. On the other hand, you had personal spending data, which shows that consumer is in a pretty healthy shape. So, inflation is off, consumer spending is pretty good. That's essentially the Goldilocks for you, or at least that's the way it seems. And this is what markets in the US responded to as well. Let's just come back and kind of circle back to levels here. So as I said, the Nifty took support of the 20-day moving average. That number is 19,577. We basically bounced 70 points off it. So the support for the Nifty as we start another trading session becomes that exact 20-day, which is 19,577. That's got to hold. On the upside, I mean, we got to almost 20,000. So the markers are set on the upside. We just first need to find stability and then perhaps start another move higher. Bank Nifty took support of the 20-day moving average at 45,368. By the way, also on the Nifty Bank, it also got to the 61.8% retracement of the recent rise, which stands at 45,244. So in the case of Nifty Bank, yes, the 20-day is important, but the bigger level here is the 61.8%, and that's the 45,244. That comes under the 20-day moving average for the Nifty Bank. So that's the basic broad setup that one is working with. I mean, I would say looking at the reversal in the U.S., the data that we saw out of the U.S. on Friday, and the general setup here, still the enthusiasm in the broader markets, etc., I would kind of hesitate to say that this is done, or this is stalling, or we're starting to see a big one on the downside or anything of that sort. You want to maybe give it a day, 2 days, you could do that. But I would say, this is far from done on the upside. The point, though, is that because the market's done so well so quickly, I mean, you could expect some pullback, some sideways action. That is always the case. But otherwise, I don't think there's very much by way of big trouble ahead. 56 odd point higher is what the Nifty gap, GIFT Nifty is indicating in terms of a start. Sonia.
Oh, absolutely. And it's expected to be a good start, right? Let's not forget that it's now been 6 trading sessions since the Nifty made its last full-fledged attempt to get to that 20,000 mark. So not only haven't we seen the sun for 10 days, we haven't even seen that attempt towards 20,000 for the last 6-7 trading sessions. But let's see, this week could be the week. The markets definitely have, they are optimistic and there is an uptrend that's intact. The strong global cues is something that could aid the sentiment this morning. Remember, the Nifty has been in that range of 19,400 to 19,800. Do we get past that range convincingly this week? Time will tell. There are many cues to watch. But there was a large FI selling on Friday, so just keep that in mind. There was a net sell figure of over 1,000 crores that we saw from the FIs on Friday, but DIs bought little more than that, about 1,600 crores or so. And, for the US markets as well, Prashant was speaking about the softer inflation data. That has led to a third week of gains for the Dow, fifth week of gains for the Nasdaq. In fact, the Nasdaq has now put in almost 4% of a rally in the month of July. So July has turned out to be a really good month for the global markets. Will that translate into our markets moving higher? It could, given the kind of cues that we have. And as Prashant was also pointing out, on Friday, the June data for the US personal consumption expenditure price index continued to show easing inflation. So that's the big thing to watch out for. For our own markets, you have the auto sales that come out for the month of July tomorrow. And this time it's been a slower growth for pockets like passenger vehicles and two-wheelers. In fact, for the small car segment, demand has been weak. Discounts have gone up and there is moderation in growth. So that's something you need to keep on your radar. And lots of big earnings this week. Starting today, you have Maruti. Tomorrow, you have Ambuja Siemens. There's Titan. On Thursday, there's Bharti, Dabur, Eicher Motors. And then on Friday, you wrap it up with Mahindra and Mahindra. So a lot of nifty components will be announcing their numbers this week. So we've pretty much got our hands full in terms of data. But there are a lot of other cues across Asia that are perhaps indicating some caution in the system as well?
Well, actually, the cues are now indicating a lot of bullishness because the numbers are cautious. And I'm talking about the Chinese PMI numbers. There's contraction on the manufacturing side. For the 4th consecutive month, the July PMI has contracted. And by the way, these are official manufacturing numbers from China. So the number came in at 49.3, slight improvement from June, but still a contraction. Not just manufacturing, the non-manufacturing official Chinese PMI is at the lowest in the last 1 year. So that's weak data, but that's making markets extremely buoyant and optimistic. If you look at the Hang Seng, for instance, it's up about 2% on hopes of more stimulus. So weak data, ends up being a positive read-through for market these days. And that's what's happened. You guys have discussed the US inflation print, so I won't get into that. By the way, interesting reaction continuing on both the yields and the dollar. The dollar obviously was a little whipsawed all over the place because of the BOJ policy that came out on Friday. So that's the year-on-year picture for core PCE 4.1, which was a little lower than the 4.2 that was the estimated print. And therefore, the markets took that very well. The dollar has been very, very range-bound. Yields, the US 10-year, by the way, is inching back to the 4% mark. It cooled off after that inflation number came in, but then kind of rose again. The dollar index has been in a range. We're closer to 102 today as we're looking at it. Speaking of earnings season, and this is the most positive cue for the global setup, which is why perhaps Prashant was also saying that he wouldn't jump into reading that this rally is over and done. Because look at the strength of earnings. Almost half of the S&P 500 has reported, and 79% of those companies, about 250 companies, they've actually beaten estimates. And that's a better stat than what we have for our results season here. Prashant was, of course, alluding to that earlier on Friday as well, how we're still seeing a lot of downgrades in India. And that story continued over the weekend. Just a quick run through. SBI card, yields are declining, margins are declining. This average spend per card is declining. So it doesn't inspire much confidence. On DCB, there's higher slippages, NIMs are contracting. Marico was probably the brightest spark over the weekend earnings that we had. And we'll tell you why in our top 10 segment in just a bit. NTPC, it was a lackluster show. Revenues were down, lower generation. So short point, no outlier, positive, big surprise, earnings surprise coming in. Today's a heavy day. Maruti for sure, but then there is Power Grid, there's Bosch. On GAIL, by the way, there's a surprise double upgrade coming in from a foreign brokerage ahead of the numbers, so we'll watch out for that. A couple of interesting mid-caps, Oberoi Realty, Petronet. So it, as Sonia said, promises to be a busy day ahead.
I just couldn't catch all of that. So in the break, maybe you can give me another refresher of all the stocks that I need to watch today. But plenty happening.
Oh yeah, plenty happening. And let's just quickly give you a preview of what you need to know over the next 30 minutes or so. First half hour, we'll get you updates from across the globe. We have Foo Kien Yap of Standard Chartered Bank who will join us to discuss the setup. We'll have our research team get you the top 10 stocks for the day. And we'll do a fundamental stock analysis with our expert, Prakash Diwan, who will be with us at about 8:30 as well.
Okay, well, let's begin the week with commentary coming in from one of the best and brightest minds in the business, Chetan Seth of Nomura, who says that he remains tactically positive on stocks. He believes the recent positive momentum in stocks can continue with many supportive factors still in place. Firstly, he says the Bank of Japan and Fed events are now behind us, easing concerns about the risk of a hawkish outturn. He adds, although the Bank of Japan did surprise the market with a hawkish change in its YCC policy, he does not think the change in the policy itself will have a sustained negative follow-through in Asia ex-Japan stocks.
Okay, well, let's get you some money market views as well. This is B. Prasanna of ICICI Bank, who says that the dollar remained well supported by strong US activity data and a dovish ECB, while the yuan recovered with improved risk sentiment in China on the back on news of economic stimulus. He says rising crude oil prices, a pause in inflows and renewed dollar strength weakened the rupee, which earlier faced strong resistance from the Reserve Bank of India intervention against inflows. He adds US non-farm payrolls data, which is going to come out this week, will further give cues to the rupee, even as it is expected to trade between 82 to 82.6 to a dollar.
Okay, and on the bonds, here's what you can expect. Prasanna says global yields hardened with a steepening bias as participants reduced expectations of a faster rate cut post the pivot, owing to continued strong data prints and strong labor markets. He says the Bank of Japan turning out to be hawkish at the margin also took global yields higher. He says local yields mirrored the move, breaking out of the tight range that has been following for some time now. He expects markets to remain marginally under pressure as the MPC meets next week and expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25%.
Okay, and as always, we have lots of stocks to track today. So today, in our top 10 segment, we will be looking at Marico, IDFC First Bank, Star Health, MCX, RVNL and Siemens. Those are on the back of positive news flow. Meanwhile, NTPC, SBI Card, Piramal Enterprises and United Breweries are stocks on the radar, which could possibly open in the red.
Okay, well, let's get this going with our first guest on the show. Foo Kien Yap is Senior Investment Strategist at Standard Chartered. He's joining us now. Foo, great to have you with us here as always. Good morning.
Good morning.
So, this looks good for more, Foo, in your opinion?
Yeah, in terms of the equity market, I think what we are seeing is, while we do think there's upside risk, more of a melt up, if you like. I think the positioning data that we see indicates that the bears have not really thrown in the towel, and the positioning still argues for a bit more upside in terms of the markets globally. And the inflation is coming off, and I think, it's the Fed meetings that's going to be quite live right now. Our house view is that 5.5% it's done for the rest of the year is our view, but we'll wait until September to see what happens there. But with signs that inflation is coming down, and then positioning from investors, we think are still, not that bullish. So we think there is still scope for the market to go up and to rise a bit more. But our view really is to lean to Asia equities. That's our preference. We do like Asia, and it's broad across Asia, including Japan. China is seeing a rebound. India made a new high 2 weeks ago. And then in the earnings data as well, I think we're seeing Korea a bit of a rebound in the earnings. So we do like Asia equities. That's where we would lean towards.
Got it. So you like Asian equities. That's always great for markets like ours, right? And you said that the bears have not thrown in their towel just yet, so there could be more upsides. Do you reckon that a large part of the upside is already done, though, especially for a market like India? At what point of the upcycle are we in right now?
Yeah, we don't have any specific price target. I mean, we are neutral for global equities on a 6 to 12 month basis. This is for our view in 2024. But in the near term, we think there is a bit more to go. And our preference really is to lean to Asia. I mean, I'm not going to be able to quantify in terms of the upside that we see, but the earnings that's being delivered in India is very strong. We think that's double digit. That's going to be set to continue. I wouldn't really play the multiples expansion, but it's more of the earnings story continuing. But then look at it, I mean, in Asia, other parts of it, China, it's a big rebound that we're seeing. And then Korea as well, a big rebound in earnings there. So we do like these markets. And what we're saying to investors is to be overweight on these markets, but be diversified across the board in terms of the different Asian markets out there.
Okay, got that. Fook, do you look at India more specifically? What is it? If you do, then what is it that you like in the market at present? Where do you find growth and reasonable value, perhaps?
Yeah, within India, the market that we like the small and the mid caps. I think that's been very strong. Momentum has been very strong, outperforming the Nifty there. We think that can continue. And if you look at the earnings revision data, actually, fundamentally, that's what we look at. Compared to the start of the year, earnings revision has been much stronger for the small and mid caps. So that's something that we prefer. In terms of the sector perspective, what we like is your financials and industrials and healthcare. So it's a bit of a barbell approach. We think the financials credit demand continues to be strong. Industrials, in terms of the government's capex policy, is good. And having healthcare in there just balances it out. I mean, healthcare is a bit more defensive. And if you go into a bit more of an uncertain environment, we think it's good to have it in there. So those are the three sectors that we're overweight in India to balance it out. Like I say, a bit of a barbell approach.
All right. Folks, sorry, when you say healthcare, that is, you mean hospitals or not hospitals, right? Not pharma.
It'll be the healthcare sector that we look at. I mean, specifically, we're looking at the very broad healthcare sector that includes pharmas and hospitals.
Okay,
and
got it.
Got it.
That's right.
Right.
Got it. Just wanted to clear that. Fook, thanks very much. Great speaking with you. Appreciate you joining in with that perspective. It's always a pleasure having you here on CNBC-TV18. We'll take a quick commercial break here. A list of top stocks to watch is what's lined up next. Stay with us. We are back in 2.
Okay, let's begin the day, and we have plenty of stocks to talk about, so without wasting any time, NTPC is the first one on our radar. Vivek is here in the studio to tell us why he's watching that one. Vivek, good morning.
Well, good morning. NTPC declared its results, and slightly subdued set of results this particular quarter, against what was analyst expectations. However, given the regulated nature of the business, largely in line with what analysts were penciling in terms of the regulated equity as well as what was the capacity available. Now, talking about the numbers themselves, revenues were slightly muted. Unseasonal rains actually impacted the demand this time around. Along with that, lower generation trends on the back of lower demand also impacted the top line. However, EBITDA was aided by operational performance in terms of lower fuel costs as well as lower expenses. Average tariff for the quarter gone by was down 1% on a year-on-year basis, 4.53 rupees per unit versus around 4.57 rupees per unit last time around. So revenues down 2.3%, EBITDA higher by almost 17% on a year-on-year basis, much better than our poll. Margins, higher by almost 450 basis points, and profitability up almost 10%. Expecting a slight negative, reaction as far as the stock is concerned today, because the stock had run up in the event to this particular results.
So that way, so not bad. Operationally, at least, it's a strong performance. Thank you for that. Mangalam, how was Marico?
Well, Marico results were largely in line because analysts were penciling in what the company had said in the first quarter update itself, but the management commentary was rather positive. There was a beat on the bottom line led by higher other income. So let's run you through the numbers. 23 crores on the top line. Street was working with a number of 2,500 crores, 574 crores on the EBITDA. The Street was working with a number of 580 crores, not too far. And the net profit came in at 436 crores versus expectations of 416 crores. That beat is because other income came in at 46 crores versus 17 crores itself. Domestic volumes grew 3%. Again, the Street was working with a number of 2 to 3%. But gross margins, they improved 550 basis points. The company invested some of that back into ads, and as a result of which, EBITDA margins were up around 220 basis points itself. Management commentary, here's where the positivity was. They said that they will improve their volume trajectory going forward. Revenues will actually get into positive terrain in the second half of this year itself. Operating margins for FY24 should improve by about 150 basis points. And at the same time, we will see, 850 crore revenue coming in from their food business itself. So see some green on the stock, despite, remember, the stock having run up about 6% in the last couple of days before the numbers.
All right, thanks very much for that. We've seen some earnings upgrades coming through from Marico, but as Mangalam said, the stock has done well coming into these earnings last few days. Abhishek is now joining in. He's got his plate full with lots of earnings, SBI Cards, IDFC First Bank, Pyramid Enterprises. Abhishek, good morning.
Morning, Prashant. So to begin with, SBI Card, the net interest margin continues to remain on the lower side. It is at 11.5%, which is one of the lowest that you are seeing in the last 24 quarters. The revolver rate, that continues to remain static at the lower end of 24%. So for 4 quarters in a row, it's been at 24%. Credit cost is at 6-quarter high of about 6.8% when compared to 6.3% in the previous quarter. Asset quality, slight hiccup over there. You are seeing increase in gross NPA ratio. However, the most disheartening point is that the new accounts, that trajectory continued the downward momentum. It was down 20% quarter on quarter. This time around, Q4 was down about 16%. And PAT has come in at 593 crore. Motilal Oswal was working with a number of 605 crore. IDFC First Bank, inline set of numbers. Asset quality has improved. Gross NPA ratio is down to 2.17% when compared to 2.51% in the previous quarter. Even the retail gross NPA is down about 12 basis points quarter on quarter. The net interest margin largely in line with what you are seeing with other peers, a slight decline over there on a sequential basis due to cost of funds rising. PNL almost in line with our poll, both in terms of NI and PAT. Pyramid Enterprise, now that's one of the worst results that I've seen in BFSI space in Q1 FY24, given the fact that they have lost out on interest income, both YOY and quarter on quarter. You are seeing a decline of 15% and 10%. So gross NPA ratio, that's declined 100 basis points quarter on quarter to 2.8%. The disbursements have picked up. It is at 5,707 crore, up about 132% YOY and 69% quarter on quarter. AUM is down about 0.1% YOY and about 0.1% sequentially. However, the net interest income is down 31% YOY and more than 25% sequentially. Even the operating profits are very weak, down about 58% YOY and about 43.5% sequentially. So expect the stock to be weak in trade today. Back to you.
All right, thanks a lot. That's a mouthful. We'll keep revising those stocks, of course, but thanks, Abhishek, for that. Let's go across to Surbhi. She's tracking a couple of them as well. Star Health, United Breweries and MCX. Surbhi, over to you.
Thanks so much for that. So United Breweries, it was a weak set of results and that was largely led by lower volumes. Now revenue was down 7% on a year-on-year basis. The gross profit margin was down nearly 400 basis points and the management did say the volatility in the raw material prices will continue going forward. EBITDA was down nearly 16%, margins were down 110 basis points. Volumes were down 12% on a year-on-year basis. The net realizations though was up nearly 6%, but that was due to a price increase that the company had taken a few months ago. Star Health, it was a good set of numbers. The gross written premium was up 20%. The net earned premium was nearly up 13%. The combined ratio that has improved came in at 97.8%. The expense of management ratio was maintained by the management and the claims ratio has come in at 65.4% versus 66.28% same time last year. And MCX, the numbers were largely in line with estimates. On a sequential basis, the numbers were looking good. The revenues were up 9%. The software expenses were up nearly 2% and most of it is priced in by the stock as well. The EBITDA is up 5 times on a sequential basis and the PAT is up 4 times. Now the futures volume that was up 2% sequentially, but the options value that came in strong, came in up 33% sequentially.
All right, so Ruby, thanks very much for that. So keep an eye on MCX as well. Now some news flow on RVNL and Siemens. RVNL has given an update on that Vande Bharat order and shareholders at Siemens have said no to the sale of a business on a slump sale basis. Valuations are not what they like. Vivek is here with more. Vivek.
Well, good morning. Absolutely right. So RVNL, there was quite a bit of uncertainty regarding, what was the exact nature of the partnership between the company as well as the Russian partner. Remember, initially RVNL and the Russian partner emerged as the lowest bidders as far as, both delivering as well as operation as well as maintenance of 200 Vande Bharat sets. Initially, RVNL had a 25% share as far as the JV was concerned. However, newspaper reports had indicated that RVNL had actually asked the Russian partner for a higher share as far as this particular JV was concerned. However, in a clarification yesterday, the shareholding agreement has been signed and RVNL will now have a 25% stake in the JV. Now, coming to Siemens, a very interesting and important development coming in over there. The shareholders have voted against the company's proposal to sell both the low voltage motors business as well as the geared motors business to the parent entity. This particular, sale was going to be done at a valuation of 2,200 crore, and both analysts as well as shareholders had opposed this particular move, given the fact that the implied valuation for this particular stake sale was much lower than what the Siemens stock was currently trading at. In fact, Jeffrey says that the implied loss to the shareholders was close to 189 rupees a share, as the proposed sale value was at an EV to sales of close to 2.1 times versus the company multiple which trades at close to 8.4 times. So expect Siemens to be one of the top movers in today's trading session.
Oh yes, absolutely, Vivek. And this was a big one. Now remember the way the stock sold off because people were citing perhaps a little bit of a oversight in terms of keeping minority shareholder interest in mind, and they've voted down that proposal. So thanks very much for that. By the way, on RVNL, that's also a big development and a lot of clarification on Vande Bharat. We will discuss it with the management as well, all the finer points. So Rajesh Prasad, Director Operations, RVNL, joins at 9:30 to talk about how they're planning to go ahead with their JV partners for the Vande Bharat order. Okay, quick recap of our top stocks to watch. The ones that have positive news flow are Marico, IDFC First Bank, Star Health, MCX, RVNL and Siemens. The stocks that have negative news flow around them are NTPC, SBI Card, Pyramid Enterprises and United Breweries.
Okay, let's take a short break on that note. Up next, we'll be joined by market expert Prakash Diwan to discuss fundamental stock analysis. We also have the management of Route Mobile, Rajdeep Kumar Gupta, who's the MD and Group CEO of the company. He'll join in to discuss the company's Q1 performance in just a bit. Stay tuned.
Welcome back. So we're expecting a positive to flat sort of a start. The implied open is, of course, much better off. GIFT Nifty is more or less unchanged. Let's kickstart the market conversation with Prakash Diwan, who's with us on the show. Prakash, good morning. Hope you're feeling bright and sunny this Monday. So tell us, a lot of earnings have come through, but I want to talk to you about a few stocks beyond earnings, and actually Siemens is one of them, because it's a big corporate development, right? Minority shareholders saying that they're not going to take things lying down, and they've shot down this proposal from an MNC. How do you read through it? And what about the stock? Do you think this will still continue to be a bit of a, sort of a sour taste in the mouth? Or do you think it's time to lap up the stock because it's underperformed exactly because of this reason?
Good morning, Sumi. Yeah, thanks. I've had a lovely weekend, and hopefully the week also should go ahead well. So, I think specifically on the way this entire episode is panned out, and remember, this is not the first time that Siemens, the global parent, has done something which is to move a lot of the businesses into its own privately held, entities, rather than let the listed entity minority shareholders also gain out of it, right? We've seen that happen in the past. So it's something which is more of a management propensity to do these things. It probably stems from whatever conservatism or insecurity on how things pan out in some of these new businesses. But I think it's unfair, and rightfully minority shareholders are not taking it lying down, which also means that the stock would probably, it's already lost some ground when all these things started off, and it's finding it extremely difficult to catch up. So, to specifically the question of whether, this is the time to latch on or load up, I don't think this is a Maggie moment for Siemens in that sense that, there's something which is gone wrong and you could kind of get a price correction, which is a great entry point. At this point, at least, it doesn't seem like, and I'll tell you why. The area that they're talking about is high volume business, okay, and that's where you start getting newer relationships or deepening your existing relationship and sell the higher end products. So it's something which is kind of unfair to carve out of the core business, the listed entity. But the other challenge that Siemens would face with investors, particularly, is there's so much good happening in terms of the cyclical move in cap goods, particularly related to the electricity sector, that if you if you blink, you have other options that investors will really move to. And that's exactly what my anticipation is going to happen in this case.
Okay. Prakash, hi, good morning. What would you do with two stocks? What do you like in these two spaces, which have been doing very well? Power, the stocks all rallied on Friday, and pharma, which rallied on Thursday and Friday after the Cipla numbers specifically.
Good morning, Prashant. So let me take pharma first, because I think that's going to be talked about for a few more weeks for sure. So what's happening is, there's a very significant underlying turnaround in sentiment towards the large generic players in our country, and particularly the US market, which was the bane in terms of pricing power and competitive intensity. This is actually kind of turning around, or has turned around, or given indications thereof. So I think the larger pharma companies will do extremely well. But at the same time, there's a whole clutch of mid-cap pharma companies which could not necessarily be in the generic space directly, but which also are in that same ecosystem, and which would start benefiting from a change in mood, a re-rating of sorts, which is happening. And it is an under-owned sector, let's face it. I mean, there is absolutely no reason to believe that people are already fully loaded onto this sector. So the allocations could go up, and earning expectations. So, even small companies like Syngene and Glenmark and all of them have been giving you very clear indications that they've got their act together in terms of rate focus, margin growth. All of that's kind of falling in place. But look at the large cap pharmas first at this point in time for the next quarter or so, and then you'll have the mid cap pharmas also participating. So, DV's lab, for instance, I mean, it's come back. Dr. Reddy's is at probably, from a valuation perspective, it's one of the softest in so many years. So you have enough room for improvement out there if you missed out on the Ciplas and Sun Pharmas of the world. So there is a lot of interest, which I'm sure is going to happen. On the power sector, I think I would believe if you look at power equipment, that's the space where you'll continue to grow. So what's happening is the PSUs are leading the charge in terms of the government's ambitious plans to execute a lot of the electricity production build up, and all the manufacturing vendors who actually participate in that are looking at order books with very decent margin growth, with raw material costs being benign. So it's a very good setup for them. So I would focus a bit more on that side. I mean, you've seen the numbers from APAR and all of that. So look at that space rather than the generators.
Sure. Prakash, I'll just come back to you. We have plenty of stocks to talk about, but we also have a management that's joining us now. So request you to listen into this interaction. It's our first corporate interaction of the week. It's on Route Mobile. Now, Route Mobile had a weak quarterly performance if you compare it quarter on quarter. The revenue growth declined sequentially for the first time in 2 years. The company has maintained their FY24 guidance at 20%, but they speak about how the devaluation of the Naira, the currency, has impacted them quite a bit, and that's happening for a lot of industries that are affected by the Naira. Also, Route Mobile promoters will sell their full 57% stake to the Proximus Group, so plenty to discuss. Rajdeep Kumar Gupta, the MD and Group CEO at Route Mobile, joins us now to talk about that. Mr. Gupta, good morning and thanks a lot for joining in. Before I ask you about your guidance, etc., I just wanted to understand, your international business has seen a 12% fall quarter on quarter. And you said that there are, of course, challenges you're facing with the devaluation of the Naira. But is this kind of, precipitous fall something that you're expecting in Q2 and Q3 as well in the international business?
Yeah, good morning and thank you for having me on your show. If you see our numbers, Q1 is always a weaker quarter for all of us in our business, and I think that is a trend we have seen for many years. In spite of that, we have done phenomenally well. If you see a number year-on-year basis, we grew by 32% and EBITDA has also grown by 42%. So overall, if you see, because of Naira devaluation, I think has impacted a little bit to our revenue. But we are fairly confident that in this quarter and coming quarters, we are very much aligned with our guidance given to the market of 20% growth. So I don't see any challenges on that side.
Mr. Gupta, I just want to sort of deviate for a moment away from the earnings just to understand what's happening with the company. Now, we all know that the promoters have decided to sell off their entire holding. That's a little over 57%. Whatever they get out of that sale, half of that is going to be reinvested in a larger company, Telescience, as we understand. So I think a lot of people want to know what is the game plan. There will be an open offer, I believe, that gets triggered at the same price. But what's really the thought process? Will Route remain a listed entity after the merger is complete with this US entity? What's the thought process and what are your large investors telling you, a lot of the larger funds which are currently invested in Route Mobile?
Thank you for asking this question. I think this is very, from last 15 days, I'm having this question from multiple investors and I'm happy to answer this question, why this deal is very important for Route Mobile. The idea of having this partnership or this deal is very important because US is one market which is the largest market in CPaaS consumption as well as the CPaaS customer base. We have tried to build our US footprint from last 6 years and every time we failed because it's not easy for any company to going all the way from India to set up a company in US and compete directly with a company which is based in US. And I realized if I really want to make Route Mobile a bigger company and we have to have a customer base in US and the partnership with Proximus Opal, which owns 100% of Telescience, makes a sense for Route Mobile to get a direct access of enterprise customer base out of US. And that is one of the reasons we believe that this partnership is very important. Along with that, there is a lots of cross-sell, upsell opportunity between both the company in terms of digital platform which we have built, either it's a RCS, WhatsApp or an email solution. So we believe that end of the day, Route Mobile as a company going to gain more in terms of revenue as well as margin growth. And that is the reason we've always wanted to have this partnership. I had an option to exit 100%.
Mr. Gupta. No, Mr. Gupta, sorry, I'm coming in over there. So the business rationale is one aspect and you're making a strong case for that. And I think a lot of people will understand that. The question is the route and the question is the end intent of the promoter, because the whole holding is being sold. I think the promoters are making a little over 600 million euros. They're reinvesting only half that amount, keeping half of it and reinvesting half to pick up a stake of about 14.5% in the new entity. So is the intent to basically get this merger done and exit at some point, or will you be invested? And again, the bigger question, will this become a private company now? What happens? What's the life cycle ahead for Route Mobile in this new merged avatar?
So there is no intention of delisting the company. That is very clear. And I think CEO of Proximus Opal has also clarified that there is no intention, and I am going to lead the entire CPaaS business of both the company. I am going to be the CEO of Root Mobile. Also, I am going to head the entire CPaaS business of Telesign. So we have a very clear intention of we remain in Root Mobile as a Root Mobile and business as usual. There is no change as such.
Okay, all right, got that. So, Mr. Gupta, good morning. Basically, what you're saying is your holding will be smaller as compared to before, but the opportunity is much larger with this. Yes. With this structure, you get to go after enterprise clients, etc., which was not possible. You tried, as you said, but was not possible. There is this figure which has been given, 90 million euros, which is the sort of a synergy potential. That is a very large number. You know, Root Mobile's revenues can go up 50-60% even if a percentage of this actually comes true. Could you tell us, could you put this number into context for us? By when are we looking at these synergies being fully realized?
Shant, good morning. See, we are very early stage of creating a synergy between both the companies. The deal will take another 6 to 9 months to close. So anything as far as the synergy is concerned will take 8 to 9 months to come in picture. The 90 million number which has came to as a conclusion to have a synergy between both the company, I think there is almost 75% is a cost and 25% is revenue. Even you take 25% as a revenue which goes to Root Mobile directly, it is almost $125 million revenue can be added to Root Mobile. So we are very bullish about this partnership in coming quarters, but I think this entire thing get materialized in next 6 to 9 months to consider.
$125 million in revenue to Root. By when can we, if you can provide us with some sense?
Post the deal closure, and we have to wait because there are lots of regulatory approval required.
So when we get FY25 number, will this be part of the FY25? Could we see that?
Yes, you can.
So additional $125 million in FY25.
That's what we are predicting right now. That's exactly what we are predicting right now. But based on the synergies, it can be up and down also. But I think over $100 million is something which we can always look at.
Okay, so $125 million additional. So if you're looking at an FY24 growth rate of 20%, that would mean your revenues by the end of FY24 would stand at about 4,300 crores. Adding this $125 million to this piece and of course your own growth, what do you think the revenues would be by the end of FY25? What kind of growth rate are we looking at? Will it be more than 20%?
If you see the combined revenue of both the companies, almost $1 billion as of now, right? And I think if they really want to optimize the cost, I think most of the routing is going to happen from India and most of the tech is going to from India. And we believe that over 5,000 crore revenue into FY25 as a number.
Okay, so 5,000 crores is a revenue that you're targeting by the end of FY25. Got it. This includes the $125 million that will come through post this deal. I want to understand that the volume growth of the company overall is looking strong, but the realizations have dropped. And there are some estimates that indicate that it's a double-digit drop that you've seen in realizations. Can you explain that to us? I mean, what's the rationale and what's the reason for it?
I think our market share in India has increased phenomenally last quarter, and because of the India realization is lower as compared to the international realization, and that is the reason the realization per transaction has gone down. But it's a good sign to have a more market share in India.
Mr. Gupta, a quick final question. It's again something that I was trying to understand earlier. You own 57% of Root Mobile. Now you'll own 14.5% of this blended larger entity. But you're only reinvesting half the proceeds that you'll get from the stake sale. What's the intent on behalf of the promoters? Do you want to increase your stake beyond this 14.5%? Will you be here? Or will eventually is exiting the business also a possibility for promoters, maybe just being financial investors?
We were always looking out a higher percentage, but that is a percentage available for us to invest, and that is why it is 14.5%.
Okay, all right. So looking out for, so not ruling that out, but for now you'll be just under that 15%. Thank you very much, Mr. Gupta. Appreciate you joining in and running us through all of that detail on Root Mobile. Prakash is still with us, but we have to take a quick commercial break. Prakash, if you can hear me, just coming to you on Root and what to do with that name and other stocks as well. Stay with us. Okay, welcome back. There's 12 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they would want to do. The GIFT Nifty on your screen and the open that is implying for us. Gentlemen, good morning. Good to have both of you here. Mitesh, let me come to you. How are things set up? And what kind of trades would you want to put out this morning?
Morning, Prashant. See, my overall belief still remains that we've kind of moved out of a situation of making highs and higher tops, at least on the immediate intraday charts, and therefore we are looking at some kind of consolidation. Maybe a correction, but we are still not very sure of that. So at least a time-wise correction definitely looks to be on the cards. To me, 19,550, 19,400 are the key levels on the Nifty on the downside, and 19,820 and 19,950 are the supply levels. So I think we'll possibly oscillate between 19,550, 19,820, and this 270-point range could be in force for the next few days to come by. I would try to buy closer to 19,550, try and take profits around 19,800 plus levels. So very clearly, I think this will be a market where you would want to deploy range-bound strategies.
Deploy range-bound strategies in this market. Got that. Sudarshan Sukhani is also with us. Sudarshan, it's been 6 or 7 trading sessions that this market has, been in a very tight range and refusing to even make that attempt to 20,000. Forget about getting there. You think that's something that can continue this week as well, or is it going to be a completely different train of thought?
Yeah, good morning. It could be different. We've had a decent correction, a small dip, and the Nifty has reached a potential support zone, which is between 19,450 and 19,550. It touched 19,550 on Friday. That's a zone. It's not a number, but it's almost there. So today I am a buyer in the Nifty, not at the open itself. Let the market stabilize. But if there is an early morning dip or an afternoon dip, any minor dip in the Nifty for me is a buying opportunity. My stops are very clear, 19,500. With that, I am also willing to carry positions overnight. The Bank Nifty is a very different story. The Nifty had a relatively graceful correction. The Bank Nifty had a volatile correction, wide range bars, sharp sudden declines. That's not good. So the Bank Nifty should be left alone, and I'm looking to buy the Nifty today.
Okay, looking to buy the Nifty. Got that. Gentlemen, good morning. Let's get the trading ideas going as well. Sudarshan, what stocks are you working with today?
Well, I'm starting with Apollo Hospital. Apollo Hospital had a wide range of almost 6 weeks, broke out on Friday. That's very good news. New highs are always to be bought into, especially with good quality companies. So buy Apollo Hospital with a stop under 5,200. My only intraday short is AU Bank, which has broken down from a support level. It's only intraday. All short selling should be done intraday with a stop above 735. Cummins has the same pattern as the Apollo Hospital. Wide range, breakout on Friday, new highs. That's a buying opportunity with a stop under 1900. And HL is also a buy. It's the same pattern. The difference is HL hasn't actually broken out, but it has so much tailwind with it that I'm anticipating a breakout and buying in anticipation with a stop under 3,800.
Okay, 3 buys and 1 sell. Sudarshan, thanks for that. Mitesh, what about you?
Prashant, I have a similar kind of outlook, 3 buys and a sell, and I think, Apollo Hospital features on my list as well. HL nearly did, so glad that we could avoid some stocks and cater to different stocks. But Apollo Hospital, as Sudarshan also mentioned, is a buy for me as well. 52.80 is the stop loss, 5,500 or thereabouts is the trading target. That about Tata Power had a big breakout on Friday, so buy here with a stop below 230 for targets of 245. And IRCTC could be starting some kind of an up move. Recommend buying here with a stop at 622 for a first target of 653. And a sell call on Coal India with a stop at 230 half for a target of around 220.
Thanks, gentlemen, for that. We'll continue our stock talk on the other side. We'll have the pre-opening rates. Also, very important management joins in. Ramesh Iyer, the Vice Chairman and Managing Director at M&M Financial Services, will be with us to discuss the company's performance in the quarter gone by. Stay tuned. Welcome back. You're watching us live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. We're beginning a brand new day, a brand new week, and so much to talk about. This is Open Exchange. As we head into the pre-opening rates, we have market expert Prakash Diwan still with us. That gives us some time to chat about individual stocks. Prakash, I wanted your thoughts on Marico. You know, the company is quite confident and they've in fact raised their guidance on margins as well. I was going through the trajectory of the stock. In the last 1 year, the stock has done nothing. It's just up about 10%. I mean, given the kind of market momentum, do you think there's more headroom now, given the management confidence as well as the stock performance you've seen so far? I can't hear you, Prakash. If you can just unmute yourself.
Yeah, sorry. So I just want to tell you that this is one space that anyways is underinvested by and large, you know, by most investors. We've not seen a rush towards FMCG except for a few names. But, you know, Marico has been plagued with so much of raw material price issues in the last 1 year, at least at the beginning of last year, that they've just kind of got over that. And I think the management confidence stems from the fact that their price points and their product range is probably more resilient than a lot of the staples that have got impacted. So from that perspective, if both these factors work as a combination, I don't see any reason why the performance can't come back. I mean, it's a brilliant franchise. We've seen all of that in the past. It's just that it's gone through a low phase of, struggling with revenues and with margins. But that could change dramatically as things pick up in the rural economy. So I'm quite positive on this. But it's a question of relative superiority within this entire space. So if you want to buy into a Marico versus an HUL or an Nestle, that's the call. But definitely Marico seems to be coming off the out of the woods and getting into some brighter spots.
Prakash, very quickly, a couple of names. One is Route Mobile. I'm assuming you heard the conversation. Yes. What would you do with it? Supreme Industries sold off some 8-9% on Friday. Numbers came out. Volumes are very strong, but I think realizations were a bit weak. Stock's done well. Any thoughts on Supreme? And then a recent listing, one of the few which is far below its listing price still, Senco. For the first time on Friday, it saw signs of activity. The jeweler from Calcutta. Go on. 3 names.
So Route Mobile, I think it was a brilliant conversation, gets a lot of things cleared. I would wait to see the new management come in and actually draw out the roadmap in terms of how they're going to build the business from here on, because it's already priced in. The business is rewarded investors, but we need to now look at how things shape up with this new change. So I wouldn't buy into it at this point, but be patient. On Senco, I think it's more to do with a flurry of interest that came through with Tangamil, with some of the other names, Kalyan, all of that. That this is also kind of been lapped up, at least in the IPO. But I think it's priced a bit steeply as compared to the scale that it has. There are far better names in that area, Prashant. So I really won't want to look at that. I missed out on the third
Supreme.
That you
Supreme. Supreme Industries.
Supreme. Okay, so Supreme is the one that you would probably go ahead and buy. I'll tell you what is changed there. The revenue mix is not just only from the plastic space. Okay. I mean, there's a huge move in the industrials.
Prakash, I'm so sorry to come in over there, but we actually have an earnings embargo. We'll come back to Supreme in just a bit in those earnings. But Mahindra and Mahindra Financial Services came out with what looked like a slightly disappointing set for the first quarter. The stock had sold off on Friday. We do have the management now joining in, Mr. Ramesh Iyer, Chairman and Managing Director at M&M Financial Services with us. Good morning, Mr. Iyer. Thank you for taking this call. I think 2 things were of prime concern for the market on Friday. One is this big rise in your provisions. From not even 1 crore in the fourth quarter, your provisions at the end of the first quarter are at 526 crores. So why the need to build up such a strong provision buffer? Is it an asset quality situation or have you run out of your buffer? I think that was one area of concern. And the other one was a decline in margins, which is pretty severe. I mean, especially if you look at it year on year. So if you could give us some color on both these parameters.
So as far as provision is concerned, it's a growing book. And we are under Ind AS, and therefore, when the book size grows, the stage 1, stage 2 provision has to go up. And our LGD has slightly moved up, and that's a reason. And you will see this correct. We are not really concerned about the overall provision. If you look at the stage 3, which has actually come down compared to March. Stage 3 has been 4.45 in March, and it has come down to 4.35 as of June. So therefore, if you really look at the stage 3 number, they have come down, and therefore it's not worrying in a growing book. And when you are on the index, there will be some extra provision that will come in. So far as margin is concerned, it comes from two fronts. One is our product mix has changed. We have gone into little more of a Primex customer, and you will see a similar drop in our OPEX. So these kind of customer, while we offer them a lower rate, they also come at a lower operating cost and a lower credit cost. And therefore, at an ROA level, we don't see an impact arising out of this drop in NIMs. Also, that we've just increased our lending rate by 20 basis points based on our borrowing rate gone up, because when the past liability matures and you bring in new money, it comes in at a new price. And that we have pushed up our price by 20, which will have a lag effect, and you will see that also getting corrected during the year. So on both the fronts, I think we are pretty comfortable. As you see the future quarters, you will see them stand corrected.
So, Mr. Iyer, when you say stand corrected, on the margin side, I get it that your product mix has changed. But is this something that could continue through the course of FY24 in terms of a range? Because it's been a sharp drop. You're sitting at about 6.8%. So where do you think you could end FY24 with as far as NIMs are concerned?
So we are looking at this going upward of 7%. We don't see that a problem, because also the pre-owned vehicle mix is improving, and that comes at a better yield. And then our own expectation is by third, fourth quarter, will the borrowing cost also start to come down, and that should give us some benefit.
Okay, Mr. Iyer, hi, good morning. Is generally, broadly speaking, are we going to see a lot more focus on growth, maybe slightly at the margin of the cost of spreads? Is that going to be a strategy going forward?
No, so we clearly put out, if you recall, in 22 March end, when our results came out, we put out a strategy for 2025. And we said that we want to double the balance sheet from that base. And we are very much on target for that as we look at it. It's not that we're giving up margin for growth. As I just explained, we have a product mix change coming in, and a lot of vehicles which do get bought by the high-end customer, and that's an opportunity that we don't want to miss. While they do come in at a low margin, I explained that they also come at a low cost of operation and credit cost. So you will see us growth definitely coming back. AUM is growing at 28%, and we have yet to see the best seasons of the year. Rural always, the second half is the best. So growth will definitely be there, but I don't think it will be at the cost of margin. You will see our ROA retained like the previous years.
Mr. Iyer, the other thing, I think, I'm not sure how much you'd be able to or want to comment, but I have to ask you this, is this entire M&M RBL transaction. How do you look at this, I mean, broadly? You are the financial services arm in the group. And many have been saying, well, this perhaps could have been routed through M&M Financial. Have there been any conversations you can tell us about? I mean, broadly, your perspective on this.
I think there was an answer in your question, right? I mean, this is an M&M purchase, and I don't think I'm privy to any of the information. I'm extremely sorry. I don't think I can speak on this because I'm not aware of any details. And you've seen the stock exchange announcement has gone from M&M. So I think it's better for the parent to comment on, and I will not have any information on this.
Okay, Mr. Iyer, fair enough, and we'll wait to get a comment from the parent as well. But I just want to go back to the asset quality, answer for a bit. You said that provisions, which have been really high in the first quarter, they're also normalized. Can you expand on that? And within that, while the gross NPA percentage has actually come down, it's improved quarter on quarter. Can you give us an idea of write-offs? Is it because there were some write-offs as well? Or in general, are you seeing just on its own, asset quality trend improve?
No, so, previously we used to have a write-off once in 6 months. Last year, we changed it to every quarter write-off. So it will not be very different from any previous years. So one shouldn't read the number this quarter to be higher as compared to the first quarter last year, etc., because the correction was taken only last year. So therefore, that will also normalize. I don't see that a problem.
So what's the figure, sir?
What is important?
So I'm just trying to understand the write-off figure. Since now it's quarterly, what's the quarterly write-off you took this quarter?
So I think we took a write-off of close to about 300 odd crore, and they are all provided accounts, right? Ultimately, we have 18 plus, we are provided for more than 80%. So once they reach certain stage of maturity, we take this write-off. And we have just accelerated it to do it quarterly instead of doing it once in 6 months. And the most important thing one has to look at it is the stage 2 is still holding up at 6.4%, which means there is no forward flow happening to the account. And therefore, there will be no up of NPA in future if you look at the real numbers. And which is why it's important to look at the collection efficiency holding up in the first quarter at 94%. And for the first time ever in our history, the first quarter stage 3 numbers are lower than what we ended up in March. And the third, there's no forward flow. And that's the reason I say that the stage 3 going forward would look even better than what we are seeing as of now.
Okay, just one final question on the housing finance business, because it has been under pressure for a very long time. You know, losses, the gross NPAs have gone up. Is it largely because of competition? Is there something wrong internally? And what is the game plan now? I mean, do you see these losses continue?
I mean, if you look at the model that we got into, it was really an experimentation. We went deep rural, we did room expansion, room addition, and the loan size was as low as 1 lakh, 1.5 lakh kind of thing. And two incidents of disruption, mainly the COVID disruption. These customers find it very difficult to come back. Again, on a long-term basis, we won't lose this money, but it does take longer for these customers to really pay back. What we have done as a model is kind of made a change there. We have gone up a little high in the ticket size, and we have also changed the mix to 50% of the book would come from affordable housing. And therefore, the next 3 years, the book will be very, very different composition as compared to what we've seen in the past. And we are definitely going slow on the deep rural lending that we experimented. I think it was a learning. I think it's taught us certain lessons that, at that ticket size, it is going to be hard work with a lot of cost and then eventually delay in repayment. So we have therefore changed the model.
Okay, Mr. Iyer, we'll leave it there. Thank you very much for your time. Good speaking with you, sir. Thank you. Prakash is still with us. Prakash, you heard the M&M. I'll come to you on this later, but you were talking to us about Supreme. So please finish that point.
Yeah, so, what I could sense from the number from Supreme, this thing is interaction that the new thrust of, the area of growth is going to be industrial. So, which is far more resilient in terms of margins. It's got, higher value addition from the company. So in a way, whatever the company's gone through in terms of its own evolution, and that's evident in this quarter, is something which resets it for a different trajectory. So I think the sell-off was probably, more because, there was no explanation beforehand in terms of, why this would happen, why the numbers would probably be a sort. But that transition is what's probably evident, and that's exactly where things could look up. So I'm quite positive on that. On M&M, I think M&M Financial particularly, I think the situation is very tough for people who are already invested. The answer to a question whether it's good enough to invest at this point, the answer is not yet. You'll have to see all of those things, that improvement that he's talking about actually pan out, which could very likely happen. But for people who are already invested, it's a little bit of a challenging environment because credit cost is something which is not going to come off very easily for most of these NBFCs. And the environment is getting much more competitive in terms of getting into that segment, which is promising enough on margins. And you know the reasons. We've got a new player coming in. There's disruption likely. People will follow suit, change strategies, reprice themselves. So there's a lot that's happening on the NBFC space, which could take some time before the real worth of all these businesses come to fruition. So I would give it a pass at this point in time to invest afresh. Or if I'm invested, not add to it. We'll probably hold on for at least 2 quarters and wait for the second half, as Mr. said, is more promising for the business also.
Okay, got that, Prakash. Thank you very much for staying with us throughout pre-open. Look forward to connecting with you again. The pre-open, by the way, is indicating about a 20-point startup on the Nifty. So we'll see how that goes. Good time to bring our technical experts back in. Sudarshan and Mitesh are with us. So Mitesh, what's 9-10 call?
I'll go with the buy on Tata Power for targets of around 245 to about 240.
And Sudarshan, what stock would you look at?
That's Cummins. Cummins is a buy with a stop under 1900.
Okay, by the way, many stocks reacting to their numbers. 5-Star Finance is up almost about 3% reacting to its numbers. Chalet Hotels had a very good set of numbers, and that stock is also up in the green. But Siemens will be another stock that you need to look at. Vivek is here to give you the latest on that. Vivek, over to you.
Well, that's right. Like we highlighted earlier, what's actually happened over the weekend is that the shareholding voting for the company's proposed sale as far as its low voltage as well as motors business to Siemens AG was concerned has been voted against. Now, this is a significant material development as far as Siemens is concerned, given the fact that on 14th of July, the company had proposed the sale and transfer of this business to Siemens Large Drives India Private Limited. And the consideration was at 2,200 crore, which was the bone of contention between both analysts, investors, and towards the company. Now, just for some perspective, in H1 of FY23, this particular business accounted for almost 6.1% of the total revenue and 9.3% of the total operating profit. And in fact, when this particular deal was announced, Siemens stock had corrected almost 8% on the back of, the lower valuation that was given. Now, a couple of brokerages have reacted. Jefferies says that the implied loss to shareholders was almost 189 rupees a share as per the original valuation, as the sale value was given a valuation of close to EV to sales of 2.1 versus the company's much higher multiple of 8.4 times. Expect Siemens to be a large mover in today's trading session.
All right, thanks very much, Vivek, for that. Let's talk about that note from UBS on Gas Authority. Sonal has got that. Sonal, morning.
Good morning, Prashant. Well, for GAIL, there's a double upgrade which has come in from UBS. They have upgraded the stock to a buy from a sell because they think now the move will be structural on the stock versus the cyclical business that they have been talking about. Higher earnings contribution from the more stable transmission business is coming in, which is around 52% of earnings now. And this indicates that business is becoming structural versus cyclical. A return of the utility nature of the business, according to UBS, could lead to re-rating of the stock as well. And that's why they've raised the target price to 150 from 80 rupees a share. They also believe consensus estimates are yet to reflect the impact of the tariff hikes that we spoke about earlier as well, and that would be a big re-rating for the stock. They expect FY24, FY26 realized tariffs to be 6 to 13% ahead of the consensus estimates. This is coming at a time when we're expecting GAIL's results today, which are expected to be very strong on a quarter-on-quarter basis. Also remember, Q4 was really weak for the company. Now their margins are expected to come in at 8.2% versus 0.9%, and first quarter should be better, which will be driven again by their strong business, which is the transmission business, because of the tariff hike and lower LNG prices as well. The transmission segment EBIT is expected to increase 36% on a YOY basis, and this will be driven by tariff hikes and volume growth as well. So GAIL will be in focus today.
Okay, got that. Sonal, thanks very much. That's GAIL. By the way, do watch out for a smaller stock, Power Mech. That's up 18% in pre-open. That's because that company says they've won a mine development contract from SAIL, Steel Authority of India, for over 30,000 crore rupees. We need to talk to them to understand how this exactly will play out, but that's a stock that's really popping up. Abhishek, tell us more about Piramal Enterprises.
We have a couple of brokerages who have downgraded Piramal Enterprise to underperform. So CLSA has an downgraded rating on Piramal Enterprise to underperform. Target price 1,150 per share. They say that the reported operating profit has actually halved from Q4 FY23 levels. Jefferies, they have also downgraded the stock to underperformance. Target price cut to 920 per share. They say that the NIFL due to mix of interest earning assets that changed in the overall AUM at 0.85 price to book value on a 1 year forward. Risk reward seems negative given the fact that ROE is muted. So both the brokerages have turned bearish on Piramal Enterprise. Back to you.
Hey, thanks a lot, Abhishek, for that. Well, we're heading straight into the market opening, and that's the first opening tick that you're seeing for the week. Looks like it's going to be a positive start, and then perhaps we'll build on to it. The first tick on the Nifty is up about 30 odd points. The mid-caps are doing better. It's a 100-point gain already, and the Bank Nifty is up about 45 odd points. So decent opening, you'd have to say. In the green, but not too much. So flitting between red and green. Let's take a look at the top gainers. You have NTPC, which is your big gainer. Despite a subdued set of numbers, the stock is trending in the green. Power Grid is up almost about 1.5%. It's in, 0.5% now. It's in the news as well. Metal stocks are doing well this morning. JSW Steel, Hindalco in the green. Tata Motors is up about 0.5%. In fact, all auto stocks are well in the green right now. Tata Motors, Hero, a couple of others as well. Bajaj Auto also trending in the green. And then you have Pharma. Pharma has clearly been the flavor of the last many days. So Dr. Reddy's up almost about 0.3%. What's dragging the market this morning, and now, by the way, the Nifty, Sensex and Bank Nifty have moved a tad bit into the red. What's dragging is Asian Paints, down about 1.5%, Apollo Hospitals, HDFC Life, Divi's Labs. So a little bit of profit taking is what you're seeing in the pharma space. Titan comes out with numbers this week, down about 0.5%. Eicher Motors comes out with numbers this week, down about 0.6%. HUL, Bajaj Finserv, ICICI Bank, a couple of other stocks that are in the red. So largely, you would have to say quiet opening. By the way, Gland Pharma is one stock. The US FDA has cleared one of their units. So Gland Pharma is the one that's soaring this morning, up almost about 8%. And of course, Surbi will take us through the rest. But I think it's just the mid caps that are in the green, a record high there. Otherwise, the frontliners are just very quiet.
Yeah, and the clear trend today is weak financial earnings. Look at Piramal Enterprises, 6% down, DCB Bank, 3% down, SBI Card, which was a huge disappointment, as Abhishek was telling us, down 3.5%. M&M Financial continues to sell off, 3% down over there. UCO Bank is down 1%. So these are the weak financial earnings. But for this, you have a five-star finance that makes up. So some of the more smaller, more micro numbers on the NBFC side, they've been better. And five-star finance is definitely one of them. 9% up on five-star now as we speak. Stovekraft came out with a good set as well. So 4.5% up over there. Let's look at United Breweries. It was a pretty uninspiring quarter for UB. 2.5% down on that stock as well. So these are some of the early result reactions that are playing out. The stock that I was just referring to, Power Mech, is actually up 15-16%. Here a 20% circuit. Now the circuit's opened up. That's because of that gigantic 30,000 crore rupee order that they've got from SAIL. So these are the early stocks in news. RVNL reacting positively to the fact that they seem to have the contours of the JV in order now. So that's a 1.5% up move. And Siemens is up 5%. As shareholders have shot down that proposal to sell one of the business units to the overseas parent. Otherwise, on the Nifty, fairly quiet, not much headway. Bank Nifty is also in sync and in step with the Nifty, down about just 0.1, 0.2%. So, Prashant, on the index, at least, there doesn't seem to be too much clarity. I guess it's more about getting through individual stocks, news, earnings, and the reactions to them.
Absolutely. I mean, we've got 40-point lower start on the Nifty, 19,600 or so is where we are. I think we've gotten through bulk of the stuff which is moving around. Piramal is the big one, really, I mean, on the downside. And it's got tremendous volumes as well. So it's down a full almost 7% now. Look at that on very large volumes for this time of the day. SBI Card at number two, and you got M&M Finance. Intellect had a big day on the upside on Friday. It's pulling back a little bit. M&M Finance, HUL is down a little bit. Asian Paints is down about 1.25%. Apollo Hospitals is down about 1.5%. HDFC Life, Divi's Laboratories are some of the others which are coming through with cuts. United Breweries, by the way, was a disappointment. The numbers came out, I think, on Friday, was it? It's down 2.5 this morning, right at the word go. So yeah, just a few names. Standalone refiners like MRPL, etc., are selling off as well this morning. So it's a mixed kind of a start with, of course, I mean, the big gainer on the upside being Siemens and Five Star, which are up 5 and 10% respectively. So that's the start that we've gotten with this morning. So 30 points lower, neither here nor there. Saurabh Mukherjee is joining us now. He's founder at Marcellus Investment Managers. Saurabh, good to have you with us here. Thank you very much for your time. I mean, it's been an incredible first half this year, Saurabh. I think has gotten most people, I would say, right? I mean, as compared to what people would have thought this year would pan out in January as compared to where we are now, pretty much at all-time highs. What's your overall kind of picture? We're talking to you after a while. How are you looking at things from here out into the second half of this year?
Look, I think from a macro growth perspective, this is one of the most remarkable junctures I have seen in India's development. We're at the top of the rate hike cycle, and yet you have GDP growth of 6.5%. We're at the top of the rate hike cycle, yet large lenders, the HDFC banks, the Bajajes of the world are posting 30% earnings growth, 20 to 25% loan book growth. So it's a very unusual macro cycle where the rate hike piece doesn't seem to have dampened the economy. There is some dampening in consumption. So through the result season, you can see some dampening in consumption. And as you'd expect, given that the Americans have hiked by 5.5%, there is some dampening in IT services. But in the context of steep rate hikes in the space of 12 months, I've never seen anything like this in my life, where the whole world rates have gone up and yet economies are chugging along nicely. So if you then look forward over the next couple of years, Prashant, the likelihood is rates come off. China seems to be in a
proper deflationary cycle. The Chinese economy seems to be blowing up. That will exert massive deflationary pressure. So I think interest rates come off over the next couple of years, and therefore you get GDP growth upticks the world over. That should be good for stocks. That should be good for equity markets. And my suggestion to whoever's watching is, if you still haven't deployed meaningful amounts of your net worth to Indian equities, it's worth considering this as a good juncture to do so.
Okay, well, by the way, for now, although the market is very quiet, there are plenty of stocks which are looking good. 5-star Finance is getting a 5-star reception in the market, 10% higher now. Very good growth coming through. Then AUM growth of over 43%. The active loans have gone up by about 40%. So that's definitely one of the stocks to look at. And, it has a lot of the sort of peer group in that category this morning. So whether it's Chola Finance, Ujjivan Small Finance Bank, a lot of these ancillary names as well doing well. Saurabh, hi, good morning. So if this is the place to be, if India is the place to be despite the kind of run-up we've already seen, where do you generate alpha now? Where do you see the next leg of leadership emerge from?
So look, I think we're sticking to what we understand well. So I started by mentioning the large lenders we've invested in. They're doing well. Our reading is the lending space is consolidating, whether it be private sector banks or the large NBFCs. The large are getting larger in the NBFC space and in the banking space, and we are riding with the leaders here. Quick disclaimer, my parents, myself, our 10,000 clients have large positions in these stocks that I've mentioned. The second area where we've been constructive and we see more grounds to be constructive is the whole pharma ecosystem. There's consistent news emerging from America of drug shortages in America. It's not clear why America is facing such acute drug shortages. We'll have to do some more work on that. But one hypothesis I have is APIs. China makes 80% of the world's APIs, and I think China is conking off on that. That gives a great opportunity to India, which accounts only for, say, 10% of the world's API. It's a big opportunity for our API manufacturers to step up. The specialty chemicals which feed into the API ecosystem, I reckon will do well over the next couple of years as China tries to squeeze the global API cycle. And the third area where we've been trying to make some investments, hopefully we'll get some more opportunities, is the China plus one place, right? So APIs is one part of it, pharma is one part of it, but the other aspect is making electronic items, consumer durables, both for the Indian market and for the export market. China has been the dominant player in this, but the early signs from our trips to Hosur and to Chennai suggest there's a significant outsourced electronic manufacturing services industry emerging in our country, and we'll try to make some investments in that space.
Well, Saurabh, hi, good morning. I just want to go back to financials for a bit, a slightly sort of more medium-term question here. We know that, of course, Marcellus has had positions in the likes of Bajaj Finance for a very long time. You've liked that company, liked that business model. But this is a space that's not perhaps set up for disruption because we have a massive entrant coming in the form of Jio Financial Services. They've already launched a tie-up with Blackstone, for instance, on the asset management side, even before starting operations on the ground. So what kind of disruption are you right now penciling in? And at least in the near term, could it have implications for maybe, limited margins or, any other challenge in terms of business growth?
I think let's break financials up. There's plenty of different bits to that space. The mutual fund space, right? The data from America is very clear. If you look at the last 20, 25 years, led by Vanguard, BlackRock, and State Street, the American mutual fund industry has largely become a play on passive, on indexes and index funds and ETFs, right? And if you look at the last 10 years, I think there have been outflows, even though the American stock market's done well, there's been outflows out of active asset management in America over the last 20 years or so. There is no reason to believe our country would be different. I think both the re-entry of BlackRock with Jio, I'm sure the other global passive players will enter. You can see every domestic mutual fund also launching passives. I think the big story of the next 10 years will be a relentless rise of index funds and ETFs in India, which is great news for your viewers. The cost of investing in India will come down. The cost of investing in a ETF or a passive is as low as 5 to 10 bips rather than, say, 2% for active asset management. So I think the mutual fund industry will face a profit squeeze. I don't think there's any two ways about it. The mutual funds will have to work very, very hard to grow their profits because of the pressure on their yields. The lending space is a different ballgame altogether. Over the last 20 years, we've seen it's very difficult to set up a large, successful lender, whether in banks or in NBFC. Player after player has struggled because to build a credit underwriting engine which holds its quality, builds distribution, generates, say, 20% ROEs, has turned out to be close to impossible. So if you take the last 20 years, there's only been really two successful NBFC build-outs in India, Bajaj and Chola. I have no reason to believe that Jio will not be successful, but even if they are, the capital they're bringing in accounts for 5% of the NBFC industry. So there's plenty of space. Remember, HDFC is no longer an NBFC, so there's plenty of demand for NBFC paper. I'm sure Jio will be able to slot into that space, but there is a deficit of well-run, large, well-capitalized NBFCs in India. I reckon Jio will slot into that and do well. But the data for the last 20 years suggests you need a well-capitalized parent and high-quality management team. Chola and Bajaj have played that, have executed on that playbook. Others haven't succeeded. Hopefully, Jio will be the third such player in India. But we need more well-capitalized players in NBFC. I don't think there's any dearth of demand. There is a dearth of capital in NBFC space. My reckoning is Jio plugs that.
Saurabh, what have you been sort of doing at Marcellus in terms of any new ideas, any new picks, making it clear just for educational purposes, not to, get people to buy in. But what have you been doing?
So we've got a few picks that we are working on building positions, and I'll discuss those as both the research crystallizes in our head and the position building plays out. Over the last 3 months or so, we've built a meaningful position in Metropolis Healthcare. In our large cap product and consistent compounders, we've been long-standing holders of Dr. Lal Path Labs. And I'm delighted to see that with the private equity players now pulling back courtesy lack of capital. I'm delighted to see both Dr. Lal and Metropolis hiking prices. Metropolis is part of our small cap portfolio. Dr. Lal is part of our large cap portfolio. We much like Dr. Lal is strong in northern and eastern India. We think Metropolis is the strongest player in Western India, well established, highly profitable player. And as the PE funded players pull back, I think we'll see a recovery in profitability for the sort of well established Path Lab plays. In parallel, we've also built a position over the last 3-4 months in Prudent, which is a sort of a mutual fund distribution cum insurance distribution platform. The massification of financial services, in a way, the massification of financial services that Jio BlackRock will deliver. Already local distributors, local wealth managers like Prudent have delivered on this over the last decade or so. I think there's a lakh or so touch points through which products are sold, packaged financial services products are sold. So Prudent is a small cap company, but we think given the network of distribution it's built in the country, given the underlying financialization, this is a straightforward way for our clients to benefit from the rise of mutual funds, the rise of health insurance, life insurance in the lives of ordinary Indians.
Sure. All right. Saurabh, we would have loved to chat some more. We perhaps will take this to another discussion. Thanks a lot for joining us on CNBC TV18. Always appreciate your thoughts here. Well, that's the word coming in on the market, which, by the way, is very, very quiet. Not doing anything at all up until now. Flat on the Nifty and on the Sensex as well, holding on to that 66,000 mark. So gives us some time to do an exclusive conversation. Now, RVNL, as you just heard from my colleague Vivek, has reached an agreement with its Russian partner for the Vande Bharat order. So there is a lot of clarification that has come out on that front. The company's arm, Kinet Railway Solutions, and the Russian entities have finalized the partnership terms. So Rajesh Prasad, who's the Director of Operations at RVNL, joins us now to talk about that. Mr. Prasad, thanks a lot for joining in. If you can just give us a little more granular details on this entire partnership. What is the bid amount? What is your share in this partnership? What is the Russian partner's share? And, if you can, give us any more clarity on what is the kind of timeline that we are looking at?
Very good morning to all of you. And it is always nice to get connected to a esteemed TV channel. So you are asking about the 200 sets of Vande Bharat trains, the tenders. This is basically a modernization of coaches. Today I was going through a newspaper and where I found that Ministry of Railway is trying to basically renew these 800 old coaches These Vande Bharat coaches are having better safety parameters, more comfortable, they are faster, and aerodynamically it is designed. It has got faster acceleration, faster deceleration. So we have got a contract of 120 train sets and at the rate of 120 crores, and these train sets will be manufactured at Latur. This has got the comprehensive maintenance component, and the average cost is around 4% every year for this 120 train sets. So as you have said correctly, that the shareholder agreement, AOA, etc., have been signed on 28/7/2023, only few days back. And if you recall correctly, we had signed the share purchase agreement on 17th of July. And you mentioned about the Kennett Railway Solutions Limited. This company was incorporated in April 2023. So now the shareholding pattern is that MWM is having 70%, RVNL is having 25%, ALES is having 5%.
Mr.
Now
Prasad,
you have asked about the roadmap.
Sure.
Let me.
Mr. Prasad, if you could allow us to please come in over here. What we are also trying to understand is that the understanding in the market was that you were trying to increase your share in the JV beyond 25%. Originally, it was 25% with the Metro Wagon Mash at 70%, but you were apparently trying to increase that share. Is that right? And now is this final, basically, that your share will be at 25%?
Yeah, we had clarified this in the stock exchanges, number one. And whatever we were trying, it was in the interest of the project, it was in the interest of RVNL, it was in the interest of government, and it was in the interest of the nation.
Okay, got it. So, Mr. Prasad, good morning. You said a train set.
So let me complete this. Let me complete this answer. You had asked about the roadmap. So now the next step is the execution of MCMA. MCMA is the maintenance the manufacturing agreement. And the first prototype, the coach is to be manufactured at Latur within 2 years. And the second, 2 months after that, 2 years. And subsequently, 12 numbers in the first year, and then 18 next year, and then 25 onwards every year. So, and the maintenance part will be taken care of at Delhi, Jodhpur, and Bangalore. So we are going to upgrade the infrastructures at Latur, where we will be manufacturing, and some of the depots in Delhi and Jodhpur and Bangalore, we may have to upgrade that. So this is the roadmap of this, and this has got a maintenance component of 35 years. Yeah.
Okay, got it. So two questions. One, so total value over the lifetime, including manufacture and maintenance, is how much, sir?
See, if you see the total cost of the project, it is around 35,000 crores, 36,000 crores. Out of that, 8,700 crores will be our share.
And you said, sorry, what is your share?
25%, so it is 1/4, so it will be around 8,700 crores.
Right. And you will make 4%, as you said. Your margin.
The 4% is the maintenance component. See, the 120 train sets will be manufactured at Latur, and then these 120 train sets will be maintained for 35 years at different depots. The names of the depots I have just now said, and the average cost of that particular maintenance component will be 4%. So 120 crore, 4%. For 120 train sets, this will continue over a period of 35 years. So if you want to see the total numbers, so 120 trains will be around 15,000 crores, and more than 4% into 120 into 35 years into 120, that will be around 20,000 plus, and it makes around 36,000 crores. This is a rough calculation which I just wanted to give.
Okay. Mr. Prasad, lest we run out of time, I have to ask you about the OFS as well. The government has reduced its stake by about 5.5%, 5.3% to be precise. Have they given any indications to pare their stake further? And if you can just help us what the response to the OFS has been?
See, I'll take few seconds before coming to your questions. This company is 20 years, 6 months old, and it has an authorized capital of 3,000 crores and paid up share capital of 2,085 crores. The first IPO came in the April 2019, 12.16%. Then OFS 1 was 9.64%. Now, during that time, approval was taken for 15%. So the remaining part was 5.36%. So this time OFS 2 was 5.36%, which had an option of 1.96% through Green's Sue option. So the floor price was 119, and the money which has been collected through OFS2 was 1365 crores, more than 1350 crores. And earlier IPO was 475 crores and OFS1 was 550 crores. The response was very positive. You can see the tweets made by the Secretary Deepam sir. He had also said that this has been very, very successful. In fact, in first day, the subscription was 2.73 times the institutional investors. So what I want to tell you is that we are serving the nations through this.
Mr. Prasad, I agree. Yes. I just, one more question. I mean, any indications of whether the government plans to bring down their stake further?
See, madam, the first requirement was the MPS. What exactly is MPS? This is as per the SEBI regulations. That is the minimum public shareholders. That minimum should be 25%. So we have crossed that barrier of 25%. To be precise enough, it is now 72.84%. And further decision will be taken by the Government of India, Ministry of Finance and Ministry of Railways. We have got no role to play in this. But what we want to do is that we want to create more and more infrastructures. We want to serve nation in a much better manner.
Mr. Prasad, exactly. I want to go back to that point because in this conversation earlier, you made a point that whatever you were trying to do, that is increase your partnership in the JV, was in the interest of the nation, in the interest of infrastructure creation. I want to go back. That's not happened. Your stake in this JV remains at 25%. So I want to understand, yes, we know all the details of the present Vande Bharat order, but have all the outlier things been settled? Because you wanted something, you've not got it. Now you're going ahead with the present 25%, 70% sort of structure. And what does it mean for future contracts and the future of this partnership itself with the Russian entity?
See, you please try to appreciate this, that the MOU was signed with the same percentage. And some news came up and then we made the clarifications. And we had signed the shareholder agreement as per the MOU. So this is as per the plan and the project is on track and we will deliver the best quality product for the Indian Railways and Government of India. This much I can assure you.
Got it. And we take your point of view. Those were news reports. So you never...
it was a news report, but we clarified.
Correct, exactly. That's what I'm saying. I'm saying it was... there was no flip-flop on your part, on the company's part. You were at that share. There was speculation maybe you were negotiating for a higher stake. And now you kind of put out where things stand right now.
But whatever I have said, it is perfect, that it was in the interest of the project, it was in the interest of the RVNL,
absolutely.
It was in the interest of Government of India, and it was the interest of the nation also.
Got it. Mr. Prasad, what is the order book now, sir? I don't think we've had an update.
So the order book has now gone up. We have got around 65,000 crores. 35,000 crores is through the nomination. And the bidding part has now gone up to 30,000 crores. And if you realize that we have started participating in less than 2 years, we have participated in 169 bids and total costing around 95,000 crores. And we have got 30,000 crores. Few bids are yet to be finalized. So the success rate is more than 25%. And we want to have a target to have the order book of 75,000 crores to 1 lakh crores. So we are coming nearer to 75,000 crores.
That's on. What's the timeline? And this is the bidding projects that you're talking about. 75,000 to 1 lakh.
I'm talking about the total order book of 75,000 crores to 1 lakh. And bidding is 30,000 crores. Madam, you please kindly realize that this is a government company. And we have molded ourselves, and it is less than 2 years that we have gone into the market and we are executing the projects, and we have got the orders of 30,000 crores from the market.
Sir, if you can just tell us a little bit about the Mumbai Metro order. What's the latest on that? What's the quantum, the timeline, execution, etc.?
See, we are executing 6 to 7 cities, the metro cities, and metro segment is one of the preferred segments. And we are involved in all kinds of the basically projects life cycle of the metro segment, starting from the depot track, the civil engineering, the system. So Mumbai Metro, most probably it was the system tender. I do not remember exactly. The biggest order of the metro is from the Chennai Metro, where we have got 4 orders. One is the elevated and 3 the underground packages. And the first order which we got from the Indore Metro, and that particular project is also moving very well. And the first overseas project of Maldives is also moving very well. So what I can tell you is the projects which we have started bidding and got in the beginning, they have started giving the results, and the margins, etc., are also as per the previous margins available. And we are very much satisfied the way we have progressed. And 2 months back, we have also been given the status of Navratna. So congratulations to all the esteemed TV viewers, because after that we have not interacted. So everything is moving well, and hope to see better improvements in time to come.
Absolutely, Mr. Prasad. Congratulations to you as well and to the entire team. And you have ambitious targets ahead of 1 lakh crores in the form of total order book. So good luck with all of those plans, and we hope to keep talking to you as we progress along down the year. Thank you very much for joining in today.
Thank you very much. Thank you very much.
Thank you. Okay, with that, let's move on to our next management call. Equitas Small Finance Bank is on our radar. The business momentum for the first quarter has been strong, with profit coming above estimates. However, slippages have seen a slight increase. The margin has also dipped a bit. Mr. P.N. Vasudevan, MD and CEO of Equitas Small Finance Bank, is with us. Mr. Vasudevan, thanks for joining in. First, to the positives. I mean, if I talk about the business momentum, your AUM has actually grown 6.25% quarter on quarter. So that's very good sequential growth. There's good deposit momentum as well. Do you think this can continue into the rest of the year? What's the sense you're getting in terms of business momentum?
Good morning. See, Equitas, as we have been saying in the past also, we are lending into segments which are, kind of from the informal economy borrower segments, which typically do have a large level of unmet or underserved, demand from the banks. So that way, there is generally not much of an issue from the demand side. It's largely from our ability to service it in an efficient manner. That really determines our ability to grow. And so we have been guiding for a 25 plus kind of a % growth rate in the past. And I think that's something that we should continue to be able to look at. First quarter was a little stronger than normal, largely because the last year first quarter was not very strong. So on that lower basis, the growth is appearing to be 36% year on year. But we expect that this year our overall growth rate should be in the range of 25 to 30%.
Okay, 25 to 30% growth rate is what you're looking at. I do want to also talk a little bit about the slippages, because they remain elevated in Q1. Can you give us some guidance on that? I think there was a 12% rise that you saw in your slippages this time. From an average of around 200 crores plus, what do you think the slippages could be in the subsequent quarters? And any relief on asset quality that one can expect?
See, our slippages are actually quite under control. I would say it's around that 3% level. Last year, if you remember, it was in the range of around 4.5 to 5% level. It's actually come down in the fourth quarter. Fourth quarter was the best. And first quarter, we all know seasonally is supposed to be the weakest quarter in terms of collections. But actually, our first quarter collection was much more robust than the typical first quarter that normally that we have seen in the past. So our first quarter collection was good, and our annual slippage at just under the 3% level is actually quite comfortable, I would say. And also, the way we calculate slippage is like on a daily basis. So if somebody slips into an NPA today and pays it off and squares it up tomorrow, we still show it as a slippage and a recovery. So I don't know whether that could be an impact, but even otherwise at 3%, I think we are very comfortable with that. And from a portfolio quality that you mentioned, our GNPA has kind of remained flat at 2.6% quarter on quarter. And again, I think that's a good good show by the team. Because normally we have seen the first quarter that the GNPA does tend to rise up a bit and then come back in the subsequent quarters. But this time around, everything has been good. The market has been good. The economy is actually doing well. So we have also seen that impact from the customer side. The earnings has remained robust, and actually our GNPA has remained flat, which I think is probably the first time that we have seen in a long time.
So, Mr. Vasudevan, what's the outlook? I mean, are you saying that even if slippages rise, the max it will be is 3%? And can you give us some guidance on the GNPA levels as well?
Yeah, I guess the slippage should be in the same range. I don't expect it to go much beyond this, give or take maybe 10 basis points this way, that way. And from a GNPA perspective, pre-COVID, our GNPA used to be 2.5% level. We are now practically close to that at 2.6. And going forward, I think for the rest of the year, given the kind of macroeconomic factors that we have seen playing in the market, I think our GNPA should be in the range of 2.5% for the rest of the year.
Okay, 2.5% range for the gross NPA, so lower than what you've seen in Q1 and lower than what you've seen last year. That's always great to hear. Now, if you look at the book, right, the microfinance book has seen a very strong growth. It's a 40% growth that you've seen. Of course, the base is also lower, but is this something that you can sustain in the quarters to come?
See, microfinance, there was a change from RBI about a year back in terms of regulatory framework for microfinance. There is always a large concern amongst all of us in terms of over-borrowing or over-leveraging by the borrowers, because the RBI guideline was addressing the NBFC MFIs, but it was not addressing the banks. So customers could potentially borrow from NBFC MFIs up to the max allowed by RBI. And then on top of that, they could again borrow from the banks. This was about a year back scenario. About a year back, RBI came with a guideline, fresh set of guidelines, where the entire exposure of an MFI borrower is capped, irrespective whether it is from an NBFC MFI or from the universal or the small finance banks. So that has given us also some little bit of a comfort that, the overheating or the over leveraging by the borrowers is, not going to be as much. And so that is why we kind of, allowed microfinance to grow a little stronger than in the past. Today, microfinance is about 19% of the book. And by and large, we expect that to remain at that 18% level by the end of the year, which means that microfinance should grow at the overall level at which the bank should grow and retain its contribution from maybe 19, it might come down to 18 by the end of the year.
Okay, got that, Mr. Vasudevan. Just a quick final word. How is cost of funds moving? Because margins have come down. I mean, even if I look at it quarter on quarter, from 9.1%, you're down to 8.76%. So there seems to be some amount of pressure there. What's the outlook for the rest of the year on cost of funds and NIMs?
Yeah, so our portfolio, almost 83 or 84% of our portfolio is on a fixed rate basis. And so you are going to be seeing this cost of funds and the NIMs moving fairly aligned, I would say. And our cost of funds has gone up to 6.93% in the first quarter. And we believe that, based on our own internal calculations, we believe that our cost of funds might actually move by another 50 basis points for the rest of the year. And when that happens, the NIMs should see a reasonably proportionate decrease also. So last year, our NIM was around the 9% on an average for the full year. This year, we expect the average NIM for the full year to be anywhere in the range of around 8.5%.
Okay, all right. We will let you go on that note. Appreciate your time here. Thanks a lot for joining in. That's Equitas Small Finance Bank. We will take a quick break. On the other side, Murli M. Natarajan, the MD and CEO at DCB Bank, will be with us to discuss the Q1 performance. Stay tuned. Okay, well, the stock on our radar this morning is Motherson Sumi Wiring India business. They saw a decline in their net profits in Q1 FY24, but the company has outperformed the market leaders in the passenger vehicle space. We spoke to Anurag Gehlot, the CEO at Motherson Sumi Wiring India, on the company's Q1 performance. He said they will continue to maintain this growth rate and it will be a good year for them. Listen in.
Year on year, the growth was there of approximately 7%. And of passenger vehicle, and quarter on quarter it has gone down, but MSWIL has done 11% and outperformed the market. And for the Q2 also, we are seeing a good forecast in hand. Obviously, festivals are going to start by the quarter 2 end and starting the Q3. So we are seeing a good numbers compared to Q1. So I think it is going to be good we can see the next, not even Q2, Q3 also we are seeing that the forecasts are high. So I think we are going in the right direction. There are a lot of positive vibes from the market. So I think it is going to be a good year. These are numbers are also driven by the customers. So whenever the customers are giving their numbers, we are just following those numbers. As far as you must be knowing that there are few issues at customer and also in their supply chain. But as a MSWIL, we are always on the toes, and we are making us ready internally to, in case of any changes in the plan, we are taking care for that. So we are driven what customer are asking us to do. Sequentially, we are improving. As you said, Q4 was 11.9%, and which has now in Q1 is 11.1. Historically, Q4 remains higher side because all your customer negotiations completed at that time. So it remains, on the higher side. But margins we are not talking about much because this is not the thing which we target for. We always look for the ROAS, which is capital employed, and as a group philosophy, we have to be more than 40% ROAS, which we have done in last financial year, and we are absolutely on the right track. And you will see in this year also we'll be surpassing this.
Okay, well, that's Motherson Sumi Wiring. Well, you got the market, which is absolutely flat, 8 or 10 point change, but higher, 19,654 on the index. Another company which is reacting to numbers in a very large way is DCB Bank. I mean, the stock is down, I think, 5.5%, 6%. Numbers have been a little mixed. So while loan growth and deposit growth, etc., have been pretty decent, slippages have gone up. And recoveries have been a little poor. That's basically led to gross NPLs rising. We also have margin compression of some 35 basis points on a quarter-on-quarter basis. So let's actually get the management in to address some of these issues. Mr. Murali M. Natarajan is Managing Director and CEO at the bank, and he's with us. So Mr. Natarajan, good to have you with us here. Thank you very much, sir. Could you explain to us, could you start with margins first of all? It's a 35 basis point compression. What are we to expect for FY24?
So we have built the business model, and I've been guiding this for quite some time, at a margin of about 370 to 375 basis point. This quarter our margin is 3.83. So I can argue that our margin is still higher than the business model that we have created. Cost of funds have been going up since, I think, almost October. The methodology works like this, that when EBLR is changed based on repo rate changes, cost of fund takes a little time to catch up. In more recently, cost of funds have not been raising so fast. So I don't expect similar kind of compression in our margin, and we should be able to hold on to our business model NIMs. More importantly, most of our portfolio is repriceable portfolio. So therefore, even if the cost of funds goes up, I don't believe that our margin compression would be severe. So we should be able to sustain with the product mix and the cost of funds mix at about 373-75 basis points.
Okay. The business momentum has been quite steady, Mr. Natarajan, and that's good to see. Of course, the entire industry is picking up pace now. But what kind of deposit and advances growth are you looking at for FY24?
So we don't give guidance on a yearly basis, but the kind of frontline investments we have done, including the number of branches that we have added in the last 1 to 2 years, and the kind of products, plus the process improvement, the technology that we are putting in, we believe that we should be able to double our balance sheet every 3 to 4 years. That is the kind of momentum we are building. Our deposit growth has been about 22%. Our loan growth has been at about 19%. But if you look a little deeply, the core products like mortgages, home loan, co-lending, construction finance, agri-inclusive banking, which is our core business, has grown at higher than 20%. So we expect this trend to continue. there is a reasonable amount of demand, and we are putting in more efforts in terms of expansion as well as increasing our front line. So that should help us to continue to grow our balance sheet and deposits and loans.
Slippages were higher in the quarter, I think about 4% as compared to 3%, the quarter-on-quarter comparison. Could you tell us what happened and what should we expect going forward?
If you look at our collection efficiency, there has been a slight drop in April, and when we look at more details, it seems to be a slow first quarter, also number of holidays in April, plus some weather interruptions in the north. All that put together has given us some kind of a lower collection efficiency in April, which we built up by May and June. If you look at our June collection efficiency, we are pretty much back to normal. The recoveries and upgrades is where we had a little bit of slowness, and we are building pipeline of recoveries and upgrades. If you look at whole of last year, our recovery and upgrades were almost 100% of the slippages. And I believe that in the next 1 to 2 quarters, we should rebuild the momentum in recovery and upgrades while slowing down the NPAs. We don't see any fundamentally any issues with our portfolio. And I also want to say that more than 85% of our portfolio is secured business. Therefore, the loss given default continues to be well within the range that we have kept in our business model.
Your cost to income ratio has been around that 64% mark in the quarter gone by. Can you give us some guidance on that as well as on the operating efficiency?
The target cost income ratio is about 55%. The target cost to average is assets about 2.4, 2.5%. It will take us some time to reach there. I want to say that we are a pure retail SME business, so we don't do much of big ticket business. If you look at the market, whichever banks are in largely retail and SME business, you do see cost income ratios at 58 to 63%. So I don't think we are too different from that. Having said that, through technology, process improvement, and also because of the growth that we are likely to achieve for the investments we have made in the last couple of years, we expect cost income ratio to come down step by step.
Got it. Mr. Natarajan, on asset quality, would you like to leave us with a guidance for the year? Where would you want to be, or where would you be?
We don't give yearly guidance. If you look at the target that we are setting for ourselves is 2.5% on GNPA and 1.25, 1.5% type of on net NPA. Over time, we should do better than that. If you look at the pre-COVID, our business model, we were at about less than 2% on gross NPA and about 1% on net NPA with a strong provision coverage, which continues to be so. So our intention is to steadily move towards that direction, and that's where we are working towards.
All right, we will let you go on that note. Thanks a lot for joining in. Appreciate your thoughts. That's DCB Bank. By the way, the market is so quiet, not too much happening. Just a couple of these power stocks, NTPC, Power Grid, all doing pretty well this morning, up almost about 3% and metals also doing well. Mitesh Thakkar is back with us. Mitesh, 2 pockets that I wanted to ask you about. One was the entire auto group, because you have auto sales coming out tomorrow. There's some lackluster moves expected in passenger vehicles, etc. That's one. And within that space itself, your thoughts on Maruti, because Maruti comes out with earnings later today. Just wanted to do a chart check on these names.
Yeah. So one, I think, Maruti, if you look at it, the stock has made a fresh high of 10,036 and then came down to levels close to about 95.50. I think the zone of 9500, 95.50 is filled with support areas. If it doesn't break that, then I think the stock will again try and retest the earlier highs. The pivot here is 97.90. So once it crosses that, I think a long trade can be taken with a 100-point kind of a stop loss, and then we can look at a target of 10,200 plus. So I'll keep a watch on 9500 on the downside and 97.90 on the upside. The Nifty Auto Index, has done very well, and it's been one of the outperformers in the last leg of the move. But last 3-4 days, it's given signs of tiredness at higher levels, similar to the index. I think it's looking a situation where the profit booking will see the Nifty Auto Index consolidate, and on the downside, 15,250 could be tested, and on the upside, 15,700, 750 would be a difficult pivot. So I think it will be consolidation for the next few days. Coming to my stock calls, I have a buy on NMDC. Keep a stop at about levels of around 112.6 here, and a target of around 117 can be looked at. And India Cement is the other one, which I would recommend buying with a stop below levels of 214 for targets of 227.
Okay. Mitesh, thank you very much. We'll come back to you for more. Let's look at just one name before we take a break. Thangamile Jewelers. And that was the big gainer from last week. It was up almost 55%, Friday to Friday. It's up another 6% this morning. That's almost a micro cap, very small market cap company. But Thangamile is up another 6 after the 55% over the previous 5 trading sessions. We'll take a quick commercial break here. We are back. We'll have the management of Stovekraft to discuss their first quarter performance. Stay tuned.
Well, flat on the Nifty, really, it's all about individual companies and stocks. The mid-cap index is doing much better. Even the Nifty, even from the lows of the morning when we opened up, it's been a steady climb up. So far, so good this Monday. The next company on our radar is Stovekraft. Numbers look pretty all right. The company managed to maintain the margins, even as inflation pressures cooled off a little bit. The company saw a lot of steady growth in its small appliance segment. In fact, that's the segment that's led growth with about a 60% improvement year on year. Their induction cooktop segment was also a contributor. And the most heartening factor of the Stovekraft numbers was actually the improvement in gross margins, a 400 basis points improvement in gross profit margin. So let's see if we can connect with the management. Okay, we don't have Mr. Rajendra Gandhi. We should get him in a bit. But in the meantime, let's focus on some of the moves and shakers in the mid-cap market, which are moving beyond some of the earnings that we've mentioned. By the way, look at BLS International. Stocks up about 8 to 9%. So even beyond earnings, today you're seeing a fair amount of a leg up. Ujjivan Small Finance Bank, of course, is earnings based. That's up about 8% as well. NBCC has perked up. Some of the other railway stocks, IRFC, we spoke to RVNL just a while back, but even RVNL is up and about. So it's really the mid-cap market, which is where all the action is today.
Oh, absolutely. And even Gland Pharma, right? They got that US FDA approval. So that stock is up almost about 4%. So I take your point entirely. It is a very good market. I mean, don't let the headline index fool you. The headline index is flat. But beneath the surface, the mid-cap index is now up almost 0.5%. And take a look at the advanced decline ratio. We haven't seen this kind of market breadth in very long. At least at the start of trade, you have over 2,000 stocks on the advancing side compared to just 800 on the declining end. Just a couple of more stocks. By the way, Ujjivan Small Finance Bank is the stock of the moment, 10% higher on that one. But I think we have the management of Stovekraft.
Yeah, Mr. Gandhi is with us now. So let's talk to him about that performance. Mr. Gandhi, thank you for joining in. So 8% growth on the top line and a 400 basis point expansion in gross margins. So let's start with that huge margin expansion. That's not at the EBITDA level, but at the gross profit level. How was that achieved and is that sustainable? And also on the EBITDA margin, which you've maintained at around 8%, what's the look ahead?
Yeah, there has been multiple factors that is helping us on our gross margin, while our endeavor is to be higher in the range of 35%. There has been a softening on the input cost and some new introductions which have moved to manufacturing. There are phases where we introduce products, then assemble them and manufacture them. Many of these products have started contributing meaningfully, and so it has given us an uplift on the margin, and it is very closer to our aspired margin.
Mr.
I think going forward, we will remain in this range of 35%.
Okay, 35%. Mr. Gandhi, exactly 2 months back when we spoke with you, you had said that demand overall remains very weak. Would you want to, how have things changed, if you can talk to us about that? Are things looking up?
Yeah, see, the calendar for the festivals has actually moved this year. So generally our business is more skewed towards the second and the third quarter, where more of activity happens around the festivals. And the first and the last quarter are relatively smaller. And so the demand scenario still continues to be muted. We believe that post the beginning of Onam, things should stabilize and then demand should be back to normal. But currently it is muted.
Okay. So I didn't get that. When you say demand scenario is muted, what does it mean in terms of revenue growth for the full year, both FY24 and FY25? Are we looking at single-digit growth? And what is your outlook on margins?
Our growth comes from three factors, primarily, of course, existing product category, new product introduction, and the channel expansion. We are expanding our retail. We are seeing very good traction in our retail and very, very confident about our retail model. So we are seeing very good growth there. New product introduction has given us good growth even during this soft period. And when business resumes to normalcy, that is when the festivities kick in, even our existing product growth, we believe will contribute. So overall, for the whole year, we don't see any challenge on the demand side. But between this last quarter and the first quarter of every year, we see that demands are normally soft.
Okay.
Yeah, we continue. We believe that we will be able to grow in double-digit, at least a double-digit growth for sure.
That's double-digit volume growth, or are you talking about double-digit top-line growth this year?
So we believe, of course, this year the cost side has been favorable to us. So all that growth we want to relate it to value growth. We believe, of course, the volume growth will be higher.
Okay, so volume growth perhaps even better. Just a quick word on the product mix. What is the target for the company as you look at overall this year? Because the small appliances, they seem to be working very well for you, and you've got a lot of growth from that side. But the cooker segment, for instance, at least this quarter was flat. So let's say by the end of FY24, what will be your targeted product mix?
These three categories contribute to the revenue of the company. The cookware, that is the pressure cooker and the non-stick cookware, we continue to grow. There has been a shift, as I said, in the sales. And on the cooktop business, both induction cooktop and gas cooktop. In the gas cooktop particularly, we grew on volume, but there is a change in the mix of the sale. And we are seeing very high growth in our appliances business. There are a lot of appliances that we have moved to manufacturing, either to which we were importing in the past. There has been a huge advantage. We also introduced some new products which are, for the segment that we operate, are very aspirational, and we have made this affordable. And we are seeing very good acceptance and traction in these products. We believe in the appliances business will continue to grow, and in the years, all these three will be at the similar level. In the past, our appliances business used to be smaller of the two. I think going forward, appliances will also contribute as much as our cookware and the cooktop business.
Sure. All right. Thank you for joining in and all the best. Demand is muted, but I'm sure it'll come back in a big way given that things are improving now. We'll slip into a quick break. On the other side, our special segment, It's the Economy. Lata will catch up with V. Vaidyanathan, the MD and CEO at IDFC First Bank, to discuss the company's Q1 earnings. Stay tuned for that.
Well, markets are still dithering a bit. One would have expected today that things would be up in a way, given the boost from the US markets, but it's been a little so-so. However, some of the stocks are standing out for the performance of their Q1 numbers, and among them is IDFC First Bank. That stock has done reasonably well. The numbers are pretty good. Actually, it's a many splendored result, you will have to say. Loan growth at 26% year-on-year and 7% quarter-on-quarter. Net interest margin only marginally lower. Net interest income rising by 36% year-on-year. So, it is a many splendored result. Joining us now is Mr. V. Vaidyanathan, Managing Director and CEO. Mr. Vaidyanathan, good morning and many congratulations. It's not like a journalist to start with so much praise, but it is deserved here. So let me start with the only one difficult part of your result, the pretty high cost to income. Any plans on how you are bringing it down? If you could do that, then, you can see your ROE perhaps going to 13, 14, really surging. Why is the cost to income high and what are your plans to bring it down?
First of all, thanks for the question, Lata. It helps us to clarify. See, basically one fundamental thing all investors should take note of the bank is this at a setup stage. So whether we're building the mobile banking application, setting up the branches, setting up ATMs, putting out new products like gold loans or education loans, everything has set up costs. So while an established bank maybe built 20, 25 years ago, they built all that many years ago and today they're reaping the benefit of that. So this is the fundamental reason why cost income ratio of the bank is high. But let me tell you, directionally, it has already come down from 95 to 72. It will come down. We should, we should be patient with us.
Okay. No, of course, which also explains why your OPEX is high, growing 37%.
Well, OPEX has grown for all banks, I think, because a lot of expenses to incur, I think for the system as a whole, because of technology and all that. But I think specifically for us, it's still a setup stage. Remember, our deposits are growing by 45%. How is it growing? We've got to put something out there in terms of branches, network, etc. So, and we need that money because we have to repay high-cost borrowing, which is costing us 9%.
That's the point. Okay, then that brings me logically to the next question on margins. Just an 8 basis point fall in margins is actually very creditable because we are already in a rising interest rate and rising interest cost scenario. Do you think you can hold it here or will it slip more? For precisely the reasons you're saying.
See, we have one advantage, Lata, that our repo-linked loan book is only 24% of the book. So even if repo rates were to start coming down, like we say in due course, which I think it will, that year from now or whenever, our bank will not be much affected. Our entire repo plus MCLR book is only 39-40%. So we have some automatic cushions built into it. The second cushion that is built for our bank, which is rather unique for our bank, considering the situation, is that we have that 17,000 crores of money which we are paying. We're paying 5,000-6,000 crores every year. So that is giving us a lift. Otherwise margins should come down for the reasons we know. So they have a bit of a countervailing effect.
Okay. What is your expectation in terms of asset quality? It certainly improved, but we get this repeated sounds of alarm from unsecured credit. Some of the banks are already showing a bit of a disturbance, banks and NBFCs more. Do you think you'll be able to manage with even lower credit costs and even lower GNPA?
Yeah, as you know, in credit, the asset test is end of the day how much the credit cost, basically the provisions. Now that number is really very low for us, I think.
Yes.
And our gross NPA is only 1.53%. Our net NPA is only 4 or 0.45. So this is very low and credit cost also low. Now but the question is a fair question, and I use this opportunity to explain to all the viewers how a bank is managing such low NPA lending in our retail segments. There's only one and main reason for it. We lend to cash flow. It's very important, Lata. It's not against anything else. It's against cash flow. So imagine you saw a bank account and you saw money in the bank, say ₹1 lakh. Then we give an EMI of only 50,000 rupees. And naturally, EMI will clear. So we are very good in assessing cash flows. And that we believe is a bigger security. And frankly, we use that whether for secured loan, unsecured loan. This is the philosophy we follow. That's why for like 13, 14 years, our NPA is always so low.
Okay. Well, actually, you should tell us the secret of your deposit growth as well. It's a fairly strong deposit growth for a bank that does not have so much by way of margins. What would be what's working so well for you?
See, as you know, we dropped our interest rates by 300 basis points, not like a small amount, like 7% to 4%.
Exactly. And in spite of it, these kinds of margins.
In fact, that helped the margins, of course. But then up to 10 lakhs, we are paying only 4% today, which is not very much premium over the big banks. But still deposit going by 44. I think when we assess this situation, there are two reasons we think about it. We are really crazy about customer service. We tell our people day in and day out, service is everything for us, and so on. Things that really upset me, but only service will upset me if I find something going wrong in the bank. Okay. So that's one. Two is that one key inflection point in every bank's life, it happens when we pivot to becoming a brand, a good brand. That pivoting is happening for us. It's a very important thing. You think of bank like ICICI Bank, HDFC Bank, they're phenomenal brands. But someday they pivoted to becoming a big brand. I think we are in that kind of inflection moment.
Okay. Yeah, I mean, I would agree with that. What I meant was not margins. The fact that, you have to work harder for deposits would mean you have to pay more than others.
No, we don't have to. We are settled. We have no intention to raise interest rates from here on. But still, we are confident of raise. We feel, I can't use the word confidence with any amount of, I should be careful with that. But let me say we are comfortable to guide that our quarter-on-quarter deposits will continue to grow from here on, at least for the foreseeable future, maybe 4 quarters, 6 quarters.
But with such a strong growth of... Sorry, go ahead.
It's very strong. Wherever we open a branch, for example, any city, for us, frankly, deposit for us for the taking. Because we just have, maybe 800 branches. If we put 100 more, wherever we go, like a gush of oxygen, deposits come to our bank. There's something very powerful about a brand, Lata. I think people have not experienced it yet or discovered it yet.
Okay, that's very good to hear, extremely good to hear. Would you, if with such a strong growth of both deposits and advances, you will have to raise capital sometime soon? I mean, it's very good now, but still the growth is very strong.
No, definitely. I think by end of this year, we plan to raise 3,000 crores. So our capital adequacy is touching 17% already. We still raise 3,000 crores by end of this year.
Would you ever look at inorganic opportunities? I mean, there are still a lot of southern banks which are, well, not quite proprietor-led, but by a few communities. Would you look at inorganic expansion, even NBFCs?
Well, we are a commercial entity and we should be on the lookout all the time. There are, if you notice, the key thing for the bank to address is actually cost-income ratio. And therefore, any object that is very profitable in operating profit sense, we will be interested.
Okay. Can you give us a little more category on what you would be interested? Would it be MFIs?
It's not, we don't have a plan to look out anything like that. But certainly, let me say, any institution that is already up and running has a strong operating margin. That's important. Even PSL, we are planning to build a PSL book. Today, we are short on PSL, self-originated PSL. We, against a target of 40%, we originate only 32% on our own. By the way, this was like 15% or something a couple of years ago. It's shot up, but still, it's only 32. So we are short. So we are either buying or we're lending to MFIs and meeting the requirement. So we want such assets which can deliver PSL, can deliver profits. Other than that, frankly, if we do nothing also, we are pretty good. If you grow the way the bank is growing the next 3-4 years, you'll be surprised.
Okay. No, I just wanted to know if we should hear something in terms of inorganic growth this year itself, like FY24.
No, nothing like that. Nothing on the horizon.
Nothing on the
through your channel, I'm putting out messages out there effectively that, we will.
Okay. All right. Let's get some numbers. I heard in your conference call you all are expecting about a 25% advances growth. What are you guiding in terms of margins?
We guide for like 22 to 24. That's a safe guidance for us on the loan book side. Today, our retail book is growing faster than that. And that's because the wholesale book is still, flattish. Come forward, when the wholesale degrowth stops and infrastructure degrowth stops, then retail itself will stabilize at 25-ish. It won't go gangbusters. So, and we believe that if we grow steadily at this rate, it should be good enough. On the margin front, Lata, like I said, there are countervailing factors, I said at the beginning to you. There are some factors which should actually lift our margin, some factors should bring down our margin, like FD rates repricing. Blend 5 to 6 basis point reduction from here should be expected. But frankly, these things don't bother us, Lata, because you're looking from a quarter to quarter. I'm looking from a decade from now, but how to build the bank in the long run. These things don't matter. It's for us to more important to build it more stable and think long.
Okay. No, actually, 5 or 6 basis points from here on is not going to make a big difference at all. Even quarter. Yeah. Just a final question. Where are you seeing growth in terms of loan ask?
Small entrepreneurs is a big one. If it's a small and medium entrepreneurs, there is a very big demand coming up there. I think because of the government kind of investment happening in capex at 10 lakh crores and all that, even economy is catching good steam. That is one big area for us. It's growing very well, and they are usually, it's a working capital financing. As a bank, think of an entire book as a working capital financing book. Because even if you give us a term loan, we are looking at the cash flow. When you give a working capital loan, looking at cash flow. So whether it's retail, wholesale, small entrepreneurs, large enterprises, we are in that space, and that is really growing well. No doubt about it.
Good to hear that, because that's what the stock market seems to be telling us today. It's the mid caps that are small caps and mid caps that are doing very well.
And we are seeing it live. We are seeing it live in a day-to-day life. We are finding strong demand coming from there. Strong demand, and rural India is like totally underserved today. Totally, I can tell you. I don't know. India has been banking for 70 years, but the more I see rural India, more I'm surprised. There's no credit there. So just go there and.
So there's space for everyone.
Fantastically. Yeah, our SMA, Lata, is only 0.85. Think about it. Just forget NPA. SMA is 0.85. So these customers, rural India people, pay very well, actually.
Okay. That's very good to hear, sir. Pleasure speaking with you. Thank you very much for spending time for us, Mr. Vaidyanathan, and all the very best.
We have to wrap up on
Bazaar. We have to wrap up on Bazaar on that note. Chartbusters up next.